Good morning, everybody. Again, if you recall, last Friday after the market closed, I sent out a note discussing and highlighting the overbought and deteriorating nature on the momentum indicators among global markets and stressed that a short-term decline is imminent and highly likely. At the time I was writing my piece, I didn't have much clarity how that expected pullback could unfold, but three days later, after we all witnessed the sharp decline, now I feel like another update, although it's just 3 days after, it would be handy, given that now I have a better feeling about the sentiment, the nature of the decline, the structure of the price, and how the momentum indicators have performed, which gives me a better tools and better idea how to forecast the upcoming correction. So what we've seen with the S&P 500, the market deleted 285 points in 5 sessions, which represent 8.4% decline. We've seen Monday and Tuesday as being the 2 sharpest decline ever, which gives us a very strong idea that the nature of that decline is impulsive. Impulsive waves are never the end of the correction. And from what we can see here is that at least we can expect a 3-wave decline from the top that has been formed in February. Short term, that wave 1 down appears to be oversold, which indicates that in the next couple of trading sessions, the S&P is likely to rebound. However, that second wave up, given the breakdown that we've seen on Monday that created a massive gap between 3,259 and 3,328, is likely to act as a solid resistance for the market, which is most probably going to produce the top of wave 2, which is going to be a lower high. If that's the scenario, that is going to unfold, wave 3 could bring the market to around 2,900 points in the next couple of months. So currently, looking really short term, yesterday's overnight price action retraced to a medium-term uptrend line. We have the RSI indicator in oversold territory. The weekly RSI is also touching the oversold territory, and the stochastic indicator is oversold. So as I said, I'm expecting to see in the next couple of sessions a rebound to around 3,260, where selling pressure most probably is likely to come again and bring some weakness in the short term. So the current pullback is just the beginning. I don't see yesterday's low as the bottom of the correction, and we are likely to see elevated volatility in the next couple of months. If you recall, one of my very long pieces about the market that I wrote last year, I talk extensively on seasonality, and it's interesting that important market tops and bottoms 90% of the time have been forming during the months of March and October. So interesting time. We will be watching how price action is unfolding in the next couple of months. But moving to our market, the XJL, we've seen a very strong, sharp sell-off over the past 3 days, with the market declining from a high of 7,197 to a low of 6,690, which is a 7% decline. We are concerned that the long-term uptrend line on the price is broken downwards. Medium and long-term uptrend line on the RSI indicator has been broken downwards. The weekly RSI indicator completed a failure swing point from overbought territory, which also indicates that the nature of the correction is likely to unfold in at least three-wave fashion. The current decline is impulsive. Short-term indicators are in oversold territory, so I wouldn't be surprised if we see, I wouldn't call it a dead cat bounce, but just a bounce to unwind the oversold momentum conditions in the short term before another wave down takes place. We have an imperfect double top completed, similarly to the S&P, which shows deterioration in the secondary uptrend. Key level to watch is the August low of 6,393. As a break below that level would signal the end of the secondary uptrend and is likely to trigger further weakness to around 6,200 points, where the XGO is likely to find solid support. So the almost 11 years old uptrend, we will have next Friday, 11-year anniversary of the bull trend, which started in March 2009. We don't have a sign of deterioration or reversal of the uptrend, but given the sharp sell-off, we are of the view that this year we are not likely to see such a strong rallies. Most probably the uptrend is going to take a breather, and after the selling pressure subsides, we will see the market trading in a wide trading range, and I believe that trading range can fluctuate between boundaries representing 20%. So short-term, more pain to come, but then most probably second half of the year, we will see more sustained recovery. Something interesting, the US 10-year government bonds have experienced a steady decline in yields over the past 2 months, declining from a high of 3.62 to a low, all-time low overnight of 0.1298, which is just over 60% decline in 2 months. Given that this level has been tested a third time, and we've seen a breakout last night, it looks like the markets are preempting and pricing in a rate cut, which means that over the medium to longer term, we are likely to see rates heading, the yield heading south. Short-term yields are oversold, and we can see a corrective bounce, but in the next 6 to 12 months, we are likely to see yields significantly lower than current prices today. And we have been keeping a very close eye on oil. Initially, we thought the market is likely to find support around $49, and we sent out a piece 2 weeks ago. However, last night, that support was broken, suggesting that oil is likely to make another leg lower. Key support in the near term is $42.36, which appears solid and is likely to hold. We have the RSI and the MACD indicators into oversold territory, and I think in the next couple of sessions, we will see a confirmation or a formation of a bullish divergence between the price of oil and the RSI indicator, which would cement my view that near-term support of $42 is likely to hold. We are then likely to see a rebound to at least $51, so we see a tactical opportunity in oil. The stock of interest would be Woodside Petroleum. We've been trading very frequently over the past few years, the stock, while has been trading in a trading range. If you recall my call last month, we took profits around $36 because we were expecting a pullback in the near term. And although at one point I was really tempted to start accumulating, I sat patiently on the sidelines and I held until now. But I think it's time to start looking at that stock again. It's not a screaming buy yet. However, it is in oversold levels. It's close to a band of support between $27.84 and $29.33. So that would be our accumulate or buy zone. This is a 5-year weekly chart, and the RSI and the stochastics are oversold. So I think the downside from here is likely to be limited, and this is a good technical strategy, buying oversold stocks which are near key support and the underlying commodities exhibiting similar trends. And given the massive sell-off across the board over the past 3 days, most of the stocks in the Australian market are currently in oversold territory in the short term. But one stock really captured my attention yesterday, and I think that stock represents a really low-risk buying opportunity, and that's InvoCare. This stock is exhibiting completely different pattern to the general market overall. We've seen steady declines over the past 6 months, and then quite good clean stabilization of the price, building a textbook double bottom pattern, which shows that buying interest was building up well before the good result yesterday, which pushed the price 14% higher. Now we have medium-term downtrend line broken on the upside, confirmation of a double top, significant improvement in momentum conditions. RSI has moved in the bull market range. So for me, these stocks, no matter what the markets are doing, the most likely scenario from here is to keep its upward trajectory to around $16. And I think Alex Liu has a price target of $15.80. So 2 stocks from me today, Woodside Petroleum and InvoCare. Have a great day.